Okay, let's answer some questions from the last market outlook. One of them that we'll get to is really, really long. It's an essay, so I'll probably just answer maybe the first paragraph or second paragraph, but I'm certainly not going to go through the whole thing. Even a comment like this is a little bit long, but I mean, you can read the comments, so I'll get to the gist of it. The beginning part is noting the rally on the peso, and the second part of the first paragraph is noting that there are risks if the central bank in Mexico starts cutting rates, and if the U.S. economy enters a recession, etc. And then points out that there's an article, Goldman adds to calls on overvalued Mexican peso after rally. It has moved a lot. It is being the strongest currency on the planet, period. There is no other currency that beats the Mexican peso for performance over the last, I'd even go so far as to say over the last 18 months. The peso has really performed, flirting with 17 to low 17s to print a 16 handle, which hasn't happened for quite some time on the peso. Near term, there could be some profit taking, but the momentum could continue. Good interest rates, a good carry trade from the yen to the peso seems to make a lot of sense. The yen just doesn't want to seem to move, and rates in Mexico are fairly high. The yen keeps weakening, the peso keeps strengthening. That has been one killer of a carry trade. But all good things come to pass. Inflation in Japan is rising. Maybe it is abating in Mexico. But if there is an issue, if there is a recession, and especially a global recession or any kind of exogenous event, money will run to the U.S. dollar. Money will leave the peso. It could. And I mean, it's had an incredible run. For it just to continue on with its incredible run could, but it gets harder and harder to move into the peso, considering how well it has performed so far. Let's see, your macro drivers for copper over the next cycle make sense to me. How did you translate them into a price target of 8 to 9 in the next 4 to 5 years for copper? Mining companies are really holding back on a lot of capex. So I don't see production expanding. I don't see new mines coming online. So if you dramatically increase, you remember with vehicles, EV, you're tripling the amount of copper per vehicle. So if you triple that and you move to electrify the grid and you're building new houses, catch-up houses. We saw this in the U.S. today. New home sales up 12% month over month. Housing starts we saw last week up 21%. If you have that continuing on, houses take a lot of copper as well. You're pulling from the same production supply. So I think you could get to probably double the prices that we have now. We're sitting just under $4, $3.80. Double that to $7.60 over the next 4 or 5 years. It takes 7 to 10 years to bring a copper mine on to production, even if they started now. How would rate hikes in the U.S. actually put upward pressure on interest rates in the rest of the world? I don't know. Well, you're asking as if it was a statement that's true, and you're asking why it's true. I would first say I don't know that that's a true statement. So I don't know. If you're asking for why it would do that, my answer is I don't know. If you're asking if that's a true statement, I don't think that's a true statement. And this is the long one. Look at this. I simply just can't read that much. So I'll read the first part. In several outlooks, you mentioned some of your long-term ideas for the next cycle. I'm more interested in buying whole strategy rather than active plays, but I want to research and understand well what I'm buying. I'd like to share my current view and have some questions. Mostly constrained the Russian market, still a huge deal. Okay, so I'm going to pass on all of this. This seems like you're just sharing your views, and it is long. It's really long, so I'll just skip over that. What is an appropriate level of liquidity to trade in ETF? An appropriate level of liquidity for you or within the ETF? If you're talking about within the ETF, I think if it trades anything less than 200,000 shares a day, that's rather low. Especially if it's under 100,000 shares a day, and really if it's under 50,000 shares a day, that's really, really low. Can I trade the most relatively liquid ETF for a particular sector, or is it best to avoid? Can I trade the most relatively liquid ETF, or is it best to avoid if volumes are low? Well, if you're trading the most liquid, volumes won't be low. I'm trying to execute some sector strategy. Spoke about an applied series in Indian markets. Okay, so I don't know much about the Indian market. I don't know much about liquidity in those markets at all. So I don't know what I can do to help you there. And I don't know what is a good level of volume in those particular markets. But if volume is light, if I know there are some ETFs in the US that might trade 8,000 shares a day, you simply can't, get in for more than 100 or 200 shares, because if you got to get out, let's say you eventually built a position of 10,000 shares, if you got to get out, there's no room to get out. It's going, if you're going to trade 10% of the daily volume on 7,000 shares, you're trading 700 shares a day. It's going to take you 14 days to get out, 3 weeks, basically 14 trading days, 3 weeks to get out. The damage is done. So I don't know that I would trade very low volume ETFs. Plus, they'd either have no options or options with absolutely no liquidity. Do you expect employees to start losing power of negotiation? If yes, do you expect the actual effect on office REITs to reverse as employers force them to come back? So a couple of things there. There is an assumption that because employees have negotiating power, they're going to push back against employers who want them back. In quite a few cases, it's the employers who are okay with it. There are a lot of employers who are not okay with it, who are saying you got to come back to the office, and some employees are resisting. And there are other employers who are saying, no, we're good with this. So it's not as if it's one-sided and all employers want their people back in the office. Do I expect them to start losing power of negotiation? Well, that would mean that the market comes into better balance and you have more, a higher supply of labor than there is demand. And I think at that point, if an employer wants you in the office, well, then that's what you're going to do. You're going to go in the office if you want a paycheck. But I think that a lot of the work from home probably continues for some companies where the output can be measured, so that it doesn't really matter if they're sitting in your office or sitting at home. If their output can be measured, and maybe they're even paid based on their output, then fine, have them work from anywhere, right? But if it's not output that can be measured, but it's more process oriented, that relies on collaboration and creativity and spontaneity, I do not see how you can get that done at home. That I think is the death for any company that tries to operate an innovative, creative company at a distance. I think in time it won't be innovative and it won't be creative, and it won't be operating at a distance. It'll just be gone. Question regarding your thesis: fund managers have to buy something to keep up with the performance. This may explain recent breadth increases in the market. It's very plausible as a story, but do you have any sources or data for this? Well, you don't have sources of data for that, because when I buy something, I don't have to fill out a questionnaire of why I'm buying it, right? So from your perspective, if I buy 100 shares of Alcoa, you don't know whether I'm buying whatever I can just because I want to be in the market, or if I'm really putting money in the market and I just happen to be bullish on Alcoa. So you don't know that. Nobody really knows that. But you can, if you have enough experience in the market, you know what happens when the market moves. You have to get involved in the market. You have a benchmark. It's moving. You got to get in, but you just can't stomach the valuations on those big names. You buy. You say, well, maybe now I've been watching these 10 stocks. Maybe now I'll buy those 10 stocks. They're not right where I want them to be, but good enough. The market seems to be moving. So you buy, you buy what was on your watch list. Because it's hard to jump in the market by buying stocks that have run 115, 120, 200% since the beginning of the year, expecting that in the latter half of the year they'll run another 100, 200%. That's kind of hard to expect. So no, there is no hard evidence of that. It's just behavioral. Can you please tell me what's the resource for checking the historical spread between 30-year coupon MBS to 10-year U.S. spread as shown in the bottom-up analysis? Well, you don't necessarily need the MBS spread. You could just look at the spread on the mortgage. So you can use FRED, F-R-E-D, which is the Federal Reserve Economic Database. Just Google FRED, 10-year versus 30-year FRM, and you'll get a chart. Does the concentration of Canadian companies in COPEX concern you? Nope. No. If yes, do you generally consider foreign exposure of your ETF or futures positions? Nope. No. I have a U.S. exposure at an aggregate level, and I worry about hedging at an aggregate level. Futures cost me nothing to enter. Futures are free. My gain is in U.S. dollars, but that's only the gain. The whole notional amount, the contract is for 5,000 bushels. And if it's at $7 a bushel, the notional amount is 35,000, but you pay zero to enter. You might need margin of about 4,200, but if you have Canadian dollars, your Canadian dollars will satisfy that margin. This would be US, so convert the US to Canadian at 35%. If I got, 5,600 Canadian, it acts as margin, so I don't need US dollars to act as margin. And my gains are in US, but just your gains, that's no big deal overall. So rather than hedge out each and every single position, the IB tells me exactly what my US dollar exposure is. At any given time, I know what my US currency is. I know what my unrealized gains or losses in US dollars are. I know what my dividends receivable in US dollars are, and what the value of any equities I'm holding in US dollars. So I have a total number in US, and that's all I worry about, is just one big number. What are your thoughts with Canada's raising the domestic stability buffer by 50 basis points? As I understand, the maximum used to be 2%, was increased to 4%. I'm not a Canadian investor. I'm a Canadian. But I couldn't tell you, if you said name the 10 largest stocks on the TSX, I don't have a freaking clue. If you ask me how much is the Canadian market up this year, not a clue. I have no idea. What proportion are banks, and if you ask me any of that, what proportion are the sectors, what's the largest sector, smallest sector, not a clue, not a single clue. So for me, the Canadian market is just something that occurs in the country that I live in, but I know nothing about it, really. So I don't know that I have any kind of insight on this at all. So I'll just pass on that one. If you look at the Fed chart, the recession starts after it uninverts. Well, listen, that's not true. If you look at the chart, keep in mind when you look at a chart and you see those lines that says recession, right? Let's do a time. Let's just say here's the timeline, and you see a recession. That recession, the beginning of this recession, the end of the recession is determined somewhere in the future. It's not. It doesn't happen in the moment, right? So when you say the curve uninverts, so you have an uninverted curve, and the curve uninverts, before the recession starts. Well, these are recession characteristics going on right here. Something is going on which is recessionary. It's not until much after that the NBER says, well, by the time we date it and everything, it happened over here. But during this period of time, it is obvious that this is inevitable. Here we go. So the conditions during that period of time warrant that uninversion. It's not as if la-di-da-di-da, everything's nice, let's uninvert this curve. Okay, it's uninverted. Now the recession will start to creep. Oh, and here it is. No, it doesn't happen that way. It's not as if we get to one date where everyone agrees, aha, the recession is here. We don't decide. NBER doesn't decide till sometimes 2 years later that the recession started on this date. So what you're looking at on that chart is what's called look-ahead bias, is that at any point in time you can look ahead and say, aha, there's the recession. So when you are inverted, you can look ahead and say, aha, there's the recession. But at this point in time, when you're here on the timeline, nobody has declared that a recession as of yet. Not until 2 years later does the NBER say, oh, the formal date of the recession was this month. This is the month that it started in. This is the month that it ended. It does not date in time. So if you took away all those bars of the recession, when you see the curve uninvert, that is the 2 year screaming that something is breaking, something is very bad, and there is no alternative. The Fed is going to have to respond at some point. That is the 2 year screaming at you, because the conditions are in place. It is all but inevitable at that point. All but inevitable. All that's left is to wait 2 years and 2.5 years for the NBER to tell us exactly when it did start. That's all. But the idea that it uninverts ahead of a recession, I find that sort of a misleading statement. It uninverts when everyone thinks that this is it. This is it. And the 2 year is screaming, something has to be done. The recession itself is not dated. We won't know what it is for. Like if we're in a recession right now, we won't know till 2025 when the recession started. Late 2024, 2025, maybe 2026. Because that's when the NBER will date it. So don't take those recessions as hard signals in the sand. Recessions are not like earnings where, on June 23rd, this company reported earnings and this is what it reported. A recession doesn't show up on June 15th and say, here I am. So, in the last Q&A for the market outlook, you mentioned you have some parts of the portfolio managed by external managers. Any reason for that? Yeah, strategy diversification. I'm very active and I have a particular strategy that I follow. And if you had a portfolio, let's say that you were a sponsor and you were allocating this portfolio and you decided that a certain amount were going to hedge funds, let's say, you would not put it to one hedge fund. You would want diversification of strategy, right? Diversification of strategy. You don't want it all in one strategy. You want diversification. Well, when you have, a significant amount, and I'm not just X 1 2 3 1 2 3. Move that X over. I am that, and I'm not going to give you the first number, but it's not a 1. So it is a significant amount that to do it all myself, to have that much concentrated in one strategy doesn't make a lot of sense. So you need diversification of strategy, because what if I lose my mind? What if something creeps over my brain slowly over the next couple of years, and I lose my mind, and I start, thinking that I'm something, or that something else is going on, or this or that. You gotta diversify. Why wouldn't you want to manage 100%? Because, yeah. What would you say is the added value in externally managed portfolio? Diversification of strategy. That's about it. The other issue is, what if I become incapacitated? What if I have a stroke? What if I have a heart attack? What if I get in an accident? To have all, and to have, let's say, the whole amount in my kind of strategies without me being able to monitor it on a weekly basis, and something moves against me of which I cannot hedge out because I'm incapacitated, it could cause some serious damage overall. So, it just makes sense. Charter holder, retail banking experience, Bangladesh. Last year relocated to New York, trying to have a foot in the U.S. job market. Want to be skilled in real estate, trying to have a job. Can you name any materials that I can study to be skilled in this sector? Anything to do with real estate. Any of the home builders annual reports. Any of the organizations, the REIT organization. There's that's the National Association of Real Estate Investment Trusts. There's another one of real estate. National Association of Real Estate Dealers, something like that. But any of those organizations produce a lot of research. Almost anything you can read. It isn't like there's one secret volume that has all the secrets of the industry, and here you go, and you need to be told what the name is because the Guardians don't want everybody knowing. The stuff is everywhere. Grab D.R. Horton, Lennar, Pulte, Toll Brothers, grab their annual report, start reading. Go to their website for investor relations. There's a whole bunch of presentations there. You'll learn a lot about the housing industry. And then there's all the industry organizations as well. National Association of Home Builders. I knew I'd figure it out. NAHB is another one. There's the National Association of Real Estate something or other. They have an organization. Lots of orgs that produce a lot of research. So yeah, lots of good stuff for that. Do you think my age is biasing the employer not to choose me? I don't know. I don't know you, so it's hard for me to say. I don't know if Warren Buffett at 40 would have been turned down for a job, right? So if you're finding it difficult, it's your resume, not your age. Maybe there's something on your resume. If there's a lack of experience on your resume, well, that'll do it, right? If the yen goes up, I'm wondering whether the Japanese stock market follow the same behavior as the U.S. stock market. As the Japanese stock market will go down significantly. I think it would go down significantly if interest rates go up, or at least it would stop going up. Like if interest rates go up, because right now you can borrow money in yen and pay almost nothing, and buy a whole bunch of stocks that are dividend payers, and get them. And you basically, that's a carry trade, right? You're buying the Japanese stock market with borrowed yen. You're paying almost nothing on your yen, and you're getting a dividend yield on the Japanese stocks, right? So it's what stops that trade. Well, higher interest rates would stop that trade. A stronger yen, if there's a carry trade, a stronger yen would probably force an unwind of the carry trade to some degree. And if that carry trade is to the extent that the carry trade is in equities, I don't know that it would be, right. I think if you're in equities, if you're borrowing in yen and putting in equities, that's an intra-market carry trade. I don't know that a change in the exchange rate is going to bother you. I I don't know. It's hard to say whether a strengthening yen would hurt their own stock market. Um, it would have to, there would have to be a belief that the strengthening yen was more than just temporary. Because if it's not temporary and expected to just weaken again, Japanese exports are still going to do very, very well, which means the companies in Japan who are exporting are going to do very well because the yen's super cheap. There'd have to be a belief that any strengthening of the yen is more permanent, and I think that can only come with central bank activity, which is kind of a long bet right now. Is the U.S. CAD trade purely mean reversion players or something underlying? The economic reasons I gave is that the household debt level in Canada is pretty bad. A lot of the debt is floating rate, a lot more floating rate debt in Canada. And the nature of our mortgage market is that they are 5-year fixed on a 25-year term. And every 5 years, you got to go back to the bank and sing for your supper. So that the sensitivity to changes in rates is much higher among consumers in Canada than it is in the U.S. I don't know that the Bank of Canada can go much higher without significantly breaking something. So it is just, I think that the Bank of Canada is pretty much near done. Inflation today, the CPI from Canada today, gave the Bank of Canada permission to stop. I mean, if you look at what the CPI was, lowest in 2 years, a headline, yes, but even core came in lower than expectation, even with the increase in housing prices that we've had. So they do have permission to stop, and if they do go much further, they will break something significantly, and then that can just get really ugly really fast. Do you think countries potentially adopting nuclear energy as opposed to the current proposed renewable sustainable options could be a headwind for oil and gas? Well, what would it matter? If you're transitioning to a green economy, what would it matter? But I will say this, you can throw up a wind farm and a solar farm a lot faster than you can a nuclear reactor, even a mini reactor. You're looking at, 10-15 year build out. At least a 10-15 year build out for one of those. A wind farm can happen 6 months. Same with a solar farm, 6 months to a year. Those things come online a lot faster. But no, I wouldn't. Nuclear is a slow moving army that you can see hundreds of miles away. You've got years to prepare your army. You got a decade to prepare your army before the nuclear army shows up. You see them coming a mile away. No, I don't think so. Do you have an opinion of Target as a company now that has a steep sell-off? How do you go about evaluating the potential attractiveness of stock generally? I don't know. This is the problem, and I think it has something to do with the S, right, in ESG, is you can, let's just write them out. Everyone agrees with good governance, all right? I don't even know why it's in there, tied up with these other two controversial things, because G is not controversial. So it's E and S. As far as E, if you can reduce your costs by being more environmentally friendly, if you can not spit sulfur into the air and pour chemicals into the river, I think it's a good thing. I got no problem with that, really. It's the S. Whose S is it? Target decided to put some S out there and got a lot of backlash. And unfortunately, we don't have an enlightened population generally. So sometimes their actions aren't as enlightened as they could be, but only because they don't know how to express themselves better. There's a lot of backlash against all of the LGBTQ. I can't even remember all the letters, but you know what I'm saying. And it's not because there's a disagreement with the group. There's not because there's a phobia of the group. It's because people are sick and tired of having it shoved down their throat every single time they turn around, everywhere they go. Enough is enough. And they were selling kids' coloring books as part of their display. And in those coloring books, there were men kissing. And this is for children, right? This is for children. And I think parents are just having just about enough of it. In Canada, I was reading this story today. In Canada, in Calgary, there was a school, or an Alberta school, which was for grade 9 students, was handing out a deck of cards, called the deck of sex or something like that, and each card portrayed a sex act, and they were going through some of the sex acts. One of them was urinating and defecating on your partner. And the idea was that you were never supposed to say that's gross or that's bad, but if somebody said I like that, you were supposed to say you're supposed to affirm somebody's sexual. This is great. These are 14-year-olds, right? It's gone too far. It's simply gone too far, and Target waded into it and started doing that. And the backlash is about can you please just keep your S to yourself? Right? And that's really what it's about. Being socially liberal means you do you and I'll do me. But don't force me to do you. Like, don't force your stuff down my throat. Enough is enough. And, well, Target went for that. So the question now becomes, how many other companies are going to see that S is a double-edged sword? That you have a group of people demanding they be more socially conscious, but another group of people saying, enough. I don't know. Target is a store like any other store, but when you wade into controversy, you divide, right? You end up dividing groups of people. So who's the larger group here? I don't know. But I think that Target's price action over the last little while had a bit to do, I shouldn't say a bit, had a significant amount to do with their decision on what S that they were going to push into their customers' face. And that is becoming a problem. So, I have people in this neighborhood who are religious. They go to church, and there are churches in my city. I don't care. I'm an atheist. I don't care. I'm not an anti-theist. I'm an atheist. Go ahead. I don't care. You know why I don't care? Is because they do not demand that I participate in their belief system with them. They do not put crosses in my front yard on a daily basis and call me a godophobe or a theistophobe if I take them down. They do not shove their beliefs in my face every single day, every day. They leave me alone, and I leave them alone. I drive by churches. I feel no need to shout at the church, because the church does not run out and grab me and drag me inside and demand that I participate in their belief system. See, that's what liberalism is all about. You do you, and I'll do me, and we'll tolerate each other. I'll tolerate your beliefs, and you tolerate mine, because we're not forcing them down your throat. But once you start forcing them down my throat, if all these religious people in my neighborhood drag me out of my house every Saturday, every Sunday, and demanded that I participate in their belief system, I would have a real significant problem with all of that. I would also have a significant problem if General Motors decided on every vehicle they made to put a Jesus on a cross embedded right in the dashboard. Right? Wouldn't you have a problem with that? Unless you're Christian. If you're Christian, you could put your own religious items in the vehicle, but would you have a problem with a car company who decided for you what religious icons you would have in your car? Now, if you say yes, let's just change that. Would you have a problem with a retail store that decided what type of sexual orientation and lifestyle that you were going to see? Would you have a problem with it? Why even have it in the store? Right? Why are there special towels that the group buys? Like, I get the whole inclusion thing, but, once you start, listen, as far as, again, going back to the religious people in the neighborhood, there's no exclusion. No one's excluding them because no one is forcing their beliefs on anyone else. Well, it's the same way. Anyways, I've gone on too long about this, but I think there is a growing problem with the S. And, Target had a bit of a backlash. Anheuser-Busch had a bit of a backlash. There was a story in the Canadian newsfeed today about a repair shop in London that is losing customers because it flew the pride flag. And it is not about a group of people who hate that other group of people. It's about, again, enough. It's just the enough is enough. Enough is enough is sort of where everyone is. I don't know. You know what? You tell me in the comments. You tell me if I'm way off base on this one. But I am hearing it more and more from the people I know that, whenever, these things come up, it's this big collective eye roll. And it's like, oh my God, here we go again. Like people are just exhausted with this. We get it. Enough. It doesn't have to be in my life. I don't have to fly the flag to say that I'm okay with you. Much like I don't have to go to your church to say, you do you, right? Anyways, there we go. My opinion of Target is I think it has to get through this S thing a little bit, and I think it has to back away from the S. I think all companies need to back away from the S. Again, think about GM, and let's say the board were Christian and decided that they were going to embed right into the dashboard Jesus on a cross. Standard on every car. Yeah, I think that they would lose a lot of business, right? By forcing their belief system upon all of their customers. It's okay if the board is Christian. No one would have a problem if they all go to church. But they would have a problem if suddenly they demanded you participate in this belief system by adorning their cars with their religious paraphernalia. All right, that's a long diatribe there. Right? In regards to quantitative tightening, when bonds roll off the SOMA account, what happens to that cash? It's not cash. They are, what would you call them? Reserve balances, I guess you would call them. Settlement balances. So here's the Treasury. Here are participating banks. And here is the central bank. Banks give the Treasury cash and they get bonds. That's the auction process, right? That is how the Treasury issues debt, is through the auction process. And these are approved dealers that can participate in the auction process. The central bank buys the bonds from the banks. You can call it a secondary market transaction, and then just increases their reserve accounts, right? It just increases their reserve accounts. So on the Fed's balance sheet, the reserve account of the bank goes up and bonds go up. When the Treasury redeems the bonds, they have to pay the central bank. So look what happens here for the banks. If they buy these bonds by using their excess reserves, the reserve balances go down and then the reserve balances go up. And the Treasury account, the General Treasury account is at the Fed, it goes up, right? So this goes down, then goes back up, so it's neutral over here. This goes up, which is the reserve here, that's the GTA, and the bonds go up. When they pay it back, a bond, let's say $1,000 disappears from here, and the $1,000 disappears from here, and that $1,000 disappears from the money system altogether. So when the central bank increased the reserve balance, that money showed up out of nowhere. So that when it's paid back, that money that showed up out of nowhere in all of the reserve accounts, because it went from this account to this account, simply just disappears from the system and then it's gone. Right? You wish it into being and you can wish it out of being. There is no cash at all. In the context of your analysis on REITs, I'd be curious to hear your thoughts on Brookfield. Why do they have heavy exposure to real estate? They also play in many asset classes. I'm a bit conflicted on this one. Well, why not? Now, real estate is an asset class. I'm just not sure why you're shocked at that, or why you would be surprised at that. Real estate is, I think, if you add up everything in the world, it's probably the single largest asset class by market value is real estate, period. When you think about all the houses, all the commercial properties, all the multi-family apartments, the warehouses, the malls, the offices, I don't know that there is any asset class in terms of market value that comes anywhere near the size of real estate. So if you have a diversified asset manager which has a large exposure to real estate, that would be on par with the weighting that real estate would have in the global market portfolio. The global market portfolio is the portfolio of all risky assets, tradable and not tradable. So there it is. It's just that it's absolutely huge. So it is not shocking that an asset management company would have a large allocation of real estate. Could you explain how do market makers balance their books? Is there any point they would have to buy, sell actual shares? Yes, they would. In a volatile market, one that is going up, going down, going up, going down, if there's a high amount of actual volatility, usually the buying and the selling, because they're on both sides of the transaction, can cancel each other out. So they may, somebody buys a call, they sell the call. Somebody else sells a call, they buy the call. Somebody sells a put, they buy the put. During a 5-minute interval, especially on a liquid underlying, maybe 90% of all those options just cancel out, and they're making the spread between the bid and the ask. That's hopefully what they're doing. So, you can imagine in their system as they're doing this that there is some number that shows them what their delta is at any point in time. So if their delta gets too large, they know to widen the bid-ask spread to cover the cost of it. At some point, they'll hedge out by buying or selling shares for whatever they have to hedge out. When you get a market that is very one-sided, where there's a whole bunch of call buying, not a lot of call selling, and not a lot of puts going on so that they can balance their delta, because if they have to be on a short call and then they're also on a short put, to some degree they're hedged because they have opposite deltas. So the combination, by being on both sides of all of the different trades, they can usually hedge out most of it, but they would have to go into the market to buy underlying shares. So if there tends to be just a whole bunch of call buying where they can't balance out with the other options that they're doing, it's so one-sided, then they do have to go in and buy the underlying stock, which does push up the price of things. But that is not a price-sensitive buyer. That is not a buyer that's concerned about valuation at that point. That's a buyer that is there purely for utilitarian reasons, purely to hedge. But yeah, they would have to, and they could push a market up, they could push a stock up if there is enough concentrated buying of calls without anything else going on. Could you kindly confirm if I'm reading correctly, 24 basis points of interest rates are to be felt within 3 months? No, what that is pick your lag. Interest rates work with long and variable lags. So, okay, well, maybe you believe they work with 3-month lag. Maybe you believe they work with a 9-month lag. If you think that interest rates work with a 3-month lag, there's still 24 basis points of hikes still to be felt. If you think they work with a 6-month lag, then there's 74 basis points of hikes to be felt. If you think they work with a 9-month lag, then we still haven't felt the last 200 basis points of hikes. The economy hasn't felt it. So we can agree that there are lags, that when the Fed raises rates, the whole economy doesn't feel it right away, because a lot of companies use interest rate hedges, and they had a lot of their funding in place in 2020, 2021 when rates are super low. Especially investment grade companies, they have their funding in place for the next 10 or 15 years. Their incremental funding would go out at a higher rate, but they're rather insensitive overall. So we know it does work with a lag. And we have a market that is super excited about the Fed maybe being one rate hike away from being done. Yeah, well, that's the hiking part done. The lag part still hasn't happened yet. The hiking part is done, but the lag part hasn't happened. It's like me telling you to drink this poison. And I give you little cup after little cup after little cup of poison. I say it works with a lag. And you drink the last cup of poison and you're super happy that there's no more poison to drink. Well, yeah, you're still dead. It just works with a lag. You know, you still have all that poison that still has to be felt. So you can't feel your legs right now. Give it time. Next will be your arms, then it'll be your chest, then it'll be your heart, then that's all over. So yeah, there are lags that still has to happen. So, you know, where the market seems to be so focused on the end of the rate hiking cycle that they're ignoring the fact that everyone agrees they work with long and variable lags. Well, then shouldn't we say, sure, the rate hiking cycle is done, but the effect is still in the pipeline. The effect still has to hit us, but no one seems to be concerned about that. Kind of odd. You mentioned core inflation likely to remain high. Fed's terminal rate could be higher at 5 or 5.5%. Well, I think that's true. Listen, you have a super tight labor market. You have housing on fire. You have the housing market expanding. You have durable goods orders today came in well above expectations. You seem to have the Richmond Fed and the Dallas Fed indexes, the manufacturing and the services index, coming in a lot better than anticipated. Well, where is this? Like, if all of this is going on, we're in a bull market. We're talking about no landing anymore. We're talking about 2023 bringing in record earnings. The Fed has to sit back and say, hey, you guys paying attention? We just punched you in the face 500 times and what, nothing? So yeah, they're going to have to punch a little harder. If inflation stays sticky and we have all of this going on now, after 500 basis points of rate hikes, then I can say quite confidently the neutral rate is another 200-300 basis points higher. Or the market is ignoring the fact that the lag is probably 10 to 12 months. In other words, of the 500 basis points of hikes, maybe we've only felt 150 of them. Much like the 10 shots of poison you've taken, only 1.5 of those shots have really hit you so far, and that's why your legs are paralyzed. There's still 9.5 shots to hit you. It will kill you, but it'll take time. Just because there's no more shots on the table doesn't mean you celebrate and say, yay, I survived, right? So either these lags are going to start hitting and hurting and breaking things, or if you think, no, you know, the market can handle it, then the neutral rate is significantly higher than where we are. So at the very minimum, why would the Fed lower rates ever? Ever. If the economy is handling everything the way it's handling right now and even accelerating in some sectors at 5.25%, why does the economy need lower rates? Why are we hoping for lower rates when we have the best job market in 50 years? When the PMIs seem to be improving, well, when I say PMIs, they're not PMIs, but the Richmond Fed, the Dallas Fed is improving. When the housing market seems to be accelerating, car sales seem to be going up. They went from 13.8 to a run rate of, I think we're over 14 million. Where's the problem? Durable goods orders are increasing. They're the most sensitive part of goods, is the durable goods. They came in really strong today. What do you need lower rates for? For what? For what? In which case, we are home. We're not going home with rates dropping. We are home. We are home, and all we can do is stay here or go higher. So the cost of capital has to go up. Why did you sell puts on TLT? Well, those are capital market securities, not money market securities. If interest rates go up, money market securities will have a higher yield. But capital market securities will start reflecting a broken economy and will not go along for the ride. In other words, higher money market rates will lead to a deeper curve inversion, not a bear steepening, but a deeper curve inversion, a flattening of the curve, a further flattening of the curve. And we saw that. We saw it last week as Powell was saying 50 more basis points. The Fed Fund future started pricing in higher rates. TLT rallied. TLT went up. What are your thoughts on short-term high-yield bonds right now? Sure, why not? I mean, if you're getting it for the yield, fine. The spreads are low enough, suggesting that there is no default risk over the next couple of years. But make sure you check the source of repayment. So a high-yield company that needs to repay typically does so by rolling over their debt. Unless they have a source of funding, unless they have a source of a cash flow, let's say, that's going to pay off that bond, you have to look at the source of repayment. And if it is from rolling over their debt, you have to extrapolate, well, okay, in 2 years, will the market be friendly for them to roll over their debt? That's the issue with high yield. Questions regarding HG futures. If I'm buying or selling options on continued future contract, I already answered that. The continued future contract is only for charting. It's not a tradable. Contract. Based on your analysis of copper, does it make sense to? Okay, I did answer you, and on that, you're asking for a specific trading strategy, and I'm not going to do that. Any comments you can make on companies that invest in debt and equity tranches of CLOs? Not really. Do these have similar risk as REITs due to rate exposure? Well, they're rate sensitive, yeah. Oxford Lane Capital, does the above pay 17-20% dividend pretty consistently? Any thoughts on the above? Well, it depends on, you can look at agency, and if you look at their earnings per share, yeah, it's pretty ugly because they're going to have fair value losses on their investment portfolio. However, their investment portfolio earns net interest income and dollar roll income, which is near the highest that they've been in their history. So they have the cash flow to pay for the dividends. So when you're assessing one of these companies, look at cash flow from operations and look at the dividend payout ratio as a proportion of cash flow from operations. And if it's running like 70%, 80%, you're good. If it's running like 110, 120, unsustainable. It will get cut at some point, but you want to look at what their dividend payout ratio is as a proportion of their cash flow from operations. Just curious where you found the BOC rate hike probabilities. Found it in a story. It was just listed in a story from a good source, so I used it. The BOC does there is rate hike information, but it is a matrix that I have yet to figure out. If anyone has figured out how to read that bloody matrix, please tell me, because I've yet to figure out how to read it. You were selling options up until earlier this year because you expected volatility to fall off a cliff. You were selling options. Well, when volatility was very high, volatility did fall off considerably, but it wasn't. It was through last year, and especially after COVID. Yeah. What made you arrive at the conclusion? And did you have the same option about volatility dropping after the COVID crash? Yeah, the same opinion, I think you mean. Yeah. Volatility right now is super low, so there is no volatility. I don't know that I can answer that much more than agreeing with you. Yeah. Different understanding about square footage relationship trade-off. Every online retail store requires approximately 3 times more the industrial logistics space as a comparable brick retail sale. As sale continues to shift online, more, not less, industrial logistics space is required. Well, if you're talking about warehousing space versus logistics is what we call a last mile center, like a FedEx center. Yeah, if you have an online business, you know there's going to be more of those logistics centers as opposed to just warehouses. A warehouse, I think you can put 10 Walmarts in a warehouse the size of one Walmart, because in Walmart you have your aisles and you have your shelves, and here is your human being who should be able to reach up to the shelf and grab what they want. But in a warehouse, you can stack vertically, right? That's why Costco is so profitable per square foot, because when you go into a Costco, humans are about this high. Well, all the inventory, whole bunch of inventory, is packed up on these shelves up here, and you have 1, 2, 3, maybe 3 shelves that you can shop at. Costco's are built vertically. Walmart's are built with huge footprints because they have very low shelves. Their entire store is for shopping, whereas at Costco, the bottom part of the store is for shopping, the upper part of the store is for warehouse. Next time you go into a Costco and a Walmart, look up and you'll see the difference. You'll see how Costco uses their square footage a lot better. So I think you can put a whole bunch of Walmarts into a warehouse. Maybe the other side you need for all of your, these are the conveyor belts, and here are all the trucks that are backed up, and they load up and then off they drive. Maybe because you have parking lots in front of malls that individuals go to, that you no longer need those parking lots if you have this. So if you take a mall and you get rid of the whole mall, including the parking lot, I think you would need less warehousing and logistics centers to replace all of that. That's my thinking, but I don't know about 3 times. Online order fulfillment necessitates higher inventory levels, higher inventory levels in a centralized place, in one place. You don't need 20 stores in one city if you have one distribution center, right? Because e-commerce fulfillment is much more space intensive than traditional warehousing. Okay, well, all you're doing is just making a bigger buller case, so I'll take it. I'll take it. If you also take a look at mining royalty companies, no, not really, no. Did you give up on PIC to focus more on copper? I'm leaning more towards CPEX than I am towards PIC, yeah. A bit confused with apartment REITs. Seems you consider a buying opportunity, but in previous years there would be no upside given high occupancy levels. Canadian apartment REITs. I'm not talking about the U.S. apartment REITs. Canadian apartment REITs. Only because of the sheer level of immigration that we're targeting, and there was an announcement this week that there is more space being made for what are called digital nomads. Immigration for digital nomads. These are individuals who are digitally very adept. Come on in. Well, you got to live somewhere. So, rents in Ontario up 30% year over year. When I watched the InterRent, Minto, Killam, when I watched the Cap Rate, when I watched the Canadian apartment REITs report earnings, I was blown away by their growth in net operating income. I didn't think they'd be able to put double-digit numbers up, and they did. So the recent pullback I saw as a buying opportunity. On your CAD yen trade, are you getting that done by selling CAD USC? No, I'm doing it spot. I don't believe there's a direct CAD. No, there's no contract. I'm just doing it spot. If I'm not mistaken, Interactive Brokers is your broker, but younger and inexperienced retail investors tend to go for popular brokers. Yeah, they do. What should investors look at? Just to have a sound and solid basis, help them identify the best brokers. Low cost, a broker that doesn't sell your information, a broker that charges you. In other words, you got to pay to trade. If something is free, that means you're the product. Okay, Facebook is free, you're the product. They will sell your information. Google is free, you're the product. Gmail is free, you're the product. Robinhood, free trading, you're the product. That means they're going to sell your order flow, and they do to Citadel, or at least they did. I don't know if they still do, but Interactive Brokers is not going to sell your order flow on you. You pay to trade. And you should have access to every market, every security, everywhere at all times, and the ability to have multiple currencies and trade any market that you're legally allowed to trade, and that's IB. Saw a Fed paper today that's talking about how interest rates flow through to business investment, and it has to do with weak firms. Weak firms are more likely to have their credit dry up than strong firms. Yeah. So the variability in the lag from interest rates depends on how many and how large these weak firms are. Yeah, I agree with that. Small firms get hit first. Yeah. Question about REITs. My way of determining the current approximate book value per share correct. They say their NAV would decrease by 2.2 if the spread increased by 5 basis points and 0.8% of interest rates rose 25 basis points. Interest rates have increased 6 and 18. Does this mean the current is probably 3.3? Well, let's see. 2.2 for every 5, and you're saying it's gone 6. So 4.4, that's 2.62. And 18 is roughly 70% of 25. 70% of 0.8 is 0.56 on 2.6, 3.1, 3.15. Yeah, that's probably right. What do you think of long waves of innovation and efficiency, the Quantitative waves? Russian fella died in the gulag, died very badly. Seems to complement the analysis of demographics right now. The interesting thing about the very long Quantitative wave, if you look at the very long wave and you read a book called Generations, and in this they said that every 4th generation, like you have 4 different types of generations, the 5th generation tends to repeat this generation. So you can look at the characteristics and qualities of this generation, and every generation's 20 years, so every roughly 75, 80 years, these things tend to repeat, that the qualities and values of these generations tend to repeat, which would line up with the 75, 80 year long cycle from Quantitative. So maybe there is something there, but there is a book called Generations if you want to read that one. In your market outlook tutorial, you mentioned estimating the PV of a company's equity, forecasting real cash flows using real discount rates may be preferable than using the nominal counterparts. Could you confirm the real yields you use in this argument are real risk-free rates? Well, you're not going to discount cash flows with real risk-free rates, right? What you're going to do is you're going to calculate whatever your cost of equity happens to be. And then you're going to take out the inflation component, the expected inflation component. And if you're using 5 years, you can look at the break-even, the 5-year break-evens, and take out the 5-year break-even from your cost of equity, and you'll get to a real cost of equity. You don't have to start with a real risk-free rate. Figure out what your cost of equity is using CAPM. And then if you're discounting, let's say that you're discounting 5 years of cash flow, and then you have a terminal value that you're going to discount from year 5, you can use the 5-year break-even rate which is the difference between the 5-year tips and the 5-year nominal. You can use you just subtract out the 5-year break-even rate, unless you have some idea that it would be different. But I would think that if you are calculating your nominal cost of equity, you're going to have to use more elevated rates. In other words, the risk-free rate's about 5% right now. I think that's the right one to use, even if it is for 5 years, because I do think that the neutral rate is higher than what most people think it is. I don't think we're going back to zero, not unless something really big breaks. Do you look at ISM PMIs or market PMIs? The ISM seems to get more attention. Yeah, I do. To see which of these sectors, countries are showing growth or slowdown. Yeah, I do. Yeah. I don't know what more to say on that. Most financial pundits say that as long as Treasury bills T issuance gets funded mostly by funds sitting at reverse repo, it's basically just a neutral reallocation of capital. Should have little impact on market liquidity. I agree. You disagree, because the Treasury's intent is to spend those funds back in the economy. Careful now. You're talking about liquidity in the Treasury market versus what's going on in the economy. The Treasury spending its money in the economy is not going to affect the liquidity in the Treasury market. Okay, so market liquidity, I think they mean financial market liquidity. Where they spend their money is not going to make a difference for financial market liquidity if the T-bill funding is coming out of reverse repo. It's neutral, right? It's neutral. I think what you're saying is say we're allocating funds from a pretty inert deposit to a flowing checking account, which should ultimately stimulate it towards spending. Yeah, but that is the real economy. That's not the financial markets. So there is a difference there. Well, the Fed is trying to be as restrictive as possible with rate hikes and QT. Government spending habits and expanding deficits work as countermeasure. Yeah, they do. Till the government doesn't turn restrictive itself. It's very difficult to see a meaningful liquidity drain from markets even if M2 shrinks. M2 shrinks from a very high level. Keep that in mind. To give you an idea, it rained today, and my pool is very, very high. It's above the overflow drain. Well, not the overflow drain, but the drain that captures all the debris and sucks it down into a basket that I pull out. Well, it's over that, so I have to drain the pool. So you could say you're draining liquidity from the pool. Yeah, but from a very high level. You know, yeah, I'm probably going to drain 2 inches out of that pool from a very high level. So the money supply is coming down, but from a very high level. Difficult to see meaningful liquidity drain from markets. What do you think? Yeah. I don't know that there's much to think about there. Governments will spend, much like consumers. If you give consumers a paycheck, they'll go to the mall and spend it. If you give politicians power, they will spend money because they think if they spend money in their district, that'll get them reelected again. Country be damned. Deficit be damned, future be damned. I need to get reelected. This is about me, not about you, not about the country. It's about me. And if spending money profligately in my district gets me reelected, what do I care if we bankrupt this country? What do I care? I'm getting mine. There's politics. I know you're bullish on home builders, but aren't you worried most of them are highly leveraged? And the cost of capital is rising. Most of them are highly leveraged, are they? D.R. Horton isn't. I don't think Lennar is. Highly leveraged. Maybe we have a different definition of what highly leveraged means. I'd be interested to hear your thoughts on that. Well, those are my thoughts. When we buy sell options, they have some time value that will decay each day. That's theta. How do I interpret this practically? I think you just said it. It is that part of time value that will decay each day. So if theta is 0.019, let's say you see an option with 0.019, a contract is for 100 units, so you just move the decimal over, and the option itself will decay by $1.90 a day. Yeah, I think that's it. 1.9 cents. 19 cents per day. 19 cents. I went a little too aggressive on that. 19 cents per day. So if you sold the option for $1.65 and it's 28 days to expiration, that means the very next day will decay by 19 cents. I'm currently short 550 call. Okay, July market value 34 cents. You're not getting paid a lot to stand in front of that steamroller. Sorry, man. That is not a good trade at all. I get that the delta is low, but to stand in front of this for $34 doesn't seem like it's really worth it to me, considering the margin that you would have. Theta 0.048, so 4.8 cents per day. Right, July 21st. We are June 27th. So you've got 24 days, and it will decay at 4.8 cents for the next day. No, not 480 per day, because this whole thing was 34 bucks, so it won't be 480 per day. It'll be 48 cents for the next day, but then the theta increases as you get closer to expiration, right? So let's say that you're this far away, and this is theta. Theta does this, right? This is zero theta, and this is like I don't know, let's call it 0.10. Theta decays like this, so the theta increases as you approach expiration. How can I calculate break-even points between stock price going up and short call value going down? Nvidia can go up X before I see any decrease in the market value of my short call. Well, Nvidia can go up to $550.34. After that, you start losing money. After that, you start losing money. That's about all I can say. I know you have a bullish view on Mexico due to elevated FDI and cheap labor costs, but do you have a conviction on India and the rupee? Well, India is pretty much on fire, right? Young population and larger than China, so it is I think becoming more and more of an attractor point globally. Seems like I'm reading more and more articles on new investment taking place in India. Yeah, I agree. I don't know if India is the next China. I don't know, but it is certainly a place worth looking at. It will depend on Modi's policies, I guess. When deciding on outsourcing some of your portfolio to managers, what are some key questions you ask them? Well, the finance industry really is a reputation and relationship industry above all. Sometimes you rely on reputations because trust is critically important. And you rely on reputations, especially reputations built over years. But above all, this industry, money will flow in the direction of trust and relationships, more so than anything else. I guess that's the answer. Corn prices are going down. We are at the end of an ag cycle. Yes, end of August is the end of the cycle. Given a sharp increase in USDA inventories, and this year might be the last good one for ag companies. Cycle is rolling over, and corn prices will likely be pushed below $5 a barrel due to high stock to the STU, the stock to use ratios. Majority of other crops will likely follow. Hence, I don't think deer is a next cycle play. It was highlighted on the earnings call, and analysts covering these stocks. Farmers' incomes will inevitably shrink to break even over coming 1 or max 2 years. So with this, you have some projections of what production would be, what inventories will be, what usage will be, etc. The key variable is production. Above all else, the key variable is production. You get a bad growing season, all that's off the table. So to look at these forecasts may be about, well, we have this much acreage. This is the yield per acreage. So this is the production capacity. That does not mean that will be the output, right? You get a spring flooding that floods cornfields till, I don't know, beginning of June. If you don't get your seed in mid-May, end of May, it's underwater. You're pretty much screwed on that field. So the wild card is production. Globally, the wild card is production. It's fires. You want to see a fire spread quickly. You go end of season and hit a cornfield and poof, or hit a wheat field, off it goes. And just look at Canada if you want to see what's going on with forest fires. Just look at Canada, for God's sake. So, yeah, you can look at these projections, but these are just projections based on, okay, there's this much acreage, and here's our projections of where seed will be. Here's our projections for yield. Here's our projection for output. But get a spike in natural gas. Well, that yield is going down. Some of you are thinking, what does natural gas have to do with it? Fertilizer, right? You get a spike in nat gas, and potash prices are going straight up, which means fertilizer is going to be hugely expensive. So some farmers, especially with smaller fields, aren't going to be able to afford to use fertilizer that year. Will go without it. Yields will drop. Especially if you have depressed prices to begin with. Why would I spend that money to fertilize my field to grow a crop that I have to sell at a loss? So those are all just projections overall. So that if the ending stocks end up where the projections are, then yeah, especially when the stock to use ratio is elevated, like above 20%, that's not very healthy at all. You also have to pay attention to global versus U.S. supply, because the corn contracts, ZC, are based on Toledo delivery. I think yellow number 2, Toledo. Yes, there are imports and there are exports, because there are different times of the year where you need to bring some in because it's not harvest season, and then you need to send some out because it is after harvest season. So you have exports and imports. But if you have an increase in, let's say you got a spike in energy costs up to $120 a barrel for oil, well, it's not cheap to transport that grain now, right? So it's all just a forecast. And we are seeing more and more variable weather. So, yeah, you can use the USDA's report. I think it comes out 4 times a year. I think the last one was June. The most recent one was June, I think. You can use that to look at what their projections are. But keep in mind that those are simply just projections. But I get your point. If you believe the projections, if those STU ratios are elevated, then yeah, especially going into the next cycle, which starts September 1st for corn. If you go into the next cycle with large beginning inventories, and you pull off a beautiful planting season, yeah, you could be under $5, which is why I said in the video, I would, if corn keeps pulling back for December, I would try to sell puts such that I had an engineered break-even price of around $5. I don't know that I'd get much below $5 until you get into the next season. And again, it depends on what you end the season with. We haven't gotten there yet. So, but I get your point. It is something that I think is worth paying attention to. Are the stock to use ratios. Yeah. Could you share your thoughts on uranium? I don't know much about uranium. I don't trade uranium. I don't look at it, so I have no thoughts on it. Love to hear your take on the current political landscape. Well, it's a clusterfuck. It's been that way for the last 20 years or so, and it's just getting worse. It's getting more and more clownish. As well as your thoughts on Justin Trudeau and Chrystia Freeland, the drama teacher and the reporter. Well, you know what they say, right? The drama teaching is a pathway to prime ministership, and if you are a reporter and you reported on financial matters, you're qualified to run the largest budget in the country. Look, you don't need qualifications to be a politician. That's why every loser wants to run for politics. People who couldn't get a job anywhere else are in politics. Now, whose fault is that, right? Is it the media's fault? Is it, politics itself that has just gotten to be so disgusting that no good person wants to be in it? Or is it the voters' fault because they've abdicated their role as job interviewers? These people are applying for a job. We get to hire them. And we simply don't do our job anymore. Either we vote our colors and that's it, or we vote for the most popular person. We don't vote for the most qualified person anymore. We vote for the most popular person. It is a popularity contest, and that's all it is. And when you bring it down to a popularity contest, I want you to think about high school. The kind of people who ran for popularity contests. Self-absorbed individuals who really are only interested in their own glory. Well, duh. Now what we got? We got high school popularity contests, and we expect them to run a country. Come on. I think we've abdicated our own responsibility there. A couple weeks ago, you mentioned long hog, short cattle trade, and you'd gone long 10, short 10. Oh, I already answered this. Why equal amounts of contract? Because it's per pound, right? You're playing the spread per pound, and each contract is 40,000 pounds. Yeah, I did answer that. How would the rise in interest rates impact copper prices downwards, and the move to electric vehicles you mentioned will increase the price? So currently with Fed increasing interest rates, one would want to invest in copper. Well, timing markets are brutally difficult to do. So you sort of just try to grab exposure at regular intervals where it makes sense. Why the decrease in corn prices, and why do you think wheat will decrease and soy? Well, I didn't say that they would. They had these incredible run-ups, and they seem to be giving back, and they've continued to give back. Even today. Today was an ugly day for the grains. Wheat, corn, and soy all gave back big time. I think wheat was down over 5%. Soy under 12 now. Well, under 13. I think it's in the 12s now. Corn under 6. 5 something now. Big pullbacks. Do you know why the Canadian banking system is considered safer and more stable than the U.S. banking system? Fewer banks, number one. Fewer banks. So you don't have weak players. They're all strong because there's only, six national banks. Really, 6 big banks. That's it. The loans they give sit on their balance sheet. We don't have the type of securitization of mortgages that you do in the U.S. because we don't have these 30-year fixed rate. They're not saleable in an MBS in that sense. So banks are far more careful about who they give credit to. Earnings estimate for Tyson Foods are 161. Why are they struggling for so long? That makes their valuation look high. I believe they had overcapacity. They're shutting down 2 of their chicken processing plants. They are aware of it, and they're instituting efficiency with some cuts. So let's see what happens there. With half the year in the books, can you comment on your investing performance? I'm on par with where the S&P is right now. If it wasn't for the market rally and me holding my short position, which I tried to hedge out as much as I can, if it wasn't for that, I think I'd be, I don't want to say almost double, but I'd be much higher. I'd be much higher than where I am right now. The rally just did a number on me. And, you try to hedge out as fast as you can, but you're still going to suffer. I did take some losses on that by not rolling over my June futures, but I am more convinced that I was right. So on this rally today, I did start adding to my short position, and I had another order to short the September contracts at 44.25. And this really sucked. I had a sell order at 44.25, and the market got to 44.24.75, and then turned down. And last I looked, it was 44.10. Come on, man. The power I have to control markets. I should have just lowered my price, but I thought, okay, there's 75, I'm next. And I wasn't. Why hospitality REITs go straight down during a recession? Well, they're hotels. I mean, business travel pulls back. That's the biggest earner for hotels is all the business travel, and people lose their jobs, so they're less willing to travel, and other people get a little bit more conservative, so they stay home more. So they tend to suffer the most and the fastest. Don't get upset. I went down by 70% this year. Ooh, but I'm sure the market will crash and I'll make it all back. You've been right so far, so don't give up. Buy puts and you'll get your money back. Yeah, I don't like buying puts. I don't like buying. I don't think I've ever done really well buying puts, so I don't know why. The universe probably says, oh, come on, Mark. What are you doing there? I'm happy being short. I am happy being short, and like I say, I am more convinced that I'm right. So, end of the line, boys. I will see you next week.